Hi everyone and welcome to this video. In this video we will learn about what is weighted average cost of capital, which is also known as WACC. In this video we're gonna break down WACC into its components, and we're gonna also see what are the ways a company can raise fund, which is ultimately gonna help us break down what is WACC. And then we're gonna look at the formula of WACC, and then and in the final leg we're gonna understand what is the difference between WACC and cost of equity. So let's start this video. So what exactly is WACC? WACC stands for weighted average cost of capital. Now by definition it is the average rate of return a company must pay to all its investors, or you can also say that it is the minimum return a business needs to generate in order to keep running the business. Now it is sometimes also known as the hurdle rate, which simply means that this is a hurdle for a company. If you are generating your return more than your average cost of capital, then you will be adding value to the company. But if you are not generating enough return from your investment, then you are actually destroying the value of the company. Now since we are talking about investors, let's understand in how many ways can we raise fund for a company. The very first one is through debt financing. Now debt financing is simply borrowing fund from investors. Now in debt financing what exactly happens is that you borrow fund from investor, and in return you pay them interest, and after maturity you return the principal amount. Now this is the typical definition of debt financing, where you are borrowing from investor, and in the return you are paying investor the interest they own and the principal amount at the end of the maturity. Now let's look at the second way of financing, which is equity financing. Now in equity financing happens is that you give a part of your company, and in return the investor pays you funds. Now the major difference between debt financing and equity financing is that in equity financing you give away some part of your company to the investor, while in debt financing there is no such things as giving away the company. In debt financing simply you pay the interest, and at maturity you pay the principal amount. But in equity financing you are giving a part of your company, but you are receiving fund. So it is usually seen that because equity financing has no clause of getting the amount back at the end of maturity, because there is no maturity as long as the company exists. The equity financing guy, the investor, will have the ownership in the company, so there is no principal payment at the end of the period. So the uncertainty about cash flows increases in equity financing. So it is usually seen that cost of equity is greater than cost of debt. Now what is cost of equity and cost of debt? It is simply the cost of raising the equity fund in the market. Suppose you have a company and you want to raise $100 in the market, and you went to a guy to say that I need $100, will you able to give me? And in return, I am gonna promise you that this company gonna earn you 10% return in the future. So the guy will say, okay, fine, I'm okay with 10% getting as a return from my investment. So here the cost of equity will be 10%. Now cost of equity is usually denoted with the quotation of KE or RE. It's depend on book or references, whichever reference you are looking at. And similarly, the cost of debt is nothing but your interest payment percentage. Same it goes like, suppose you want to raise $100 and you went to another guy and said that please lend me $100 and I promise you to pay 7% interest on this $100 for 5 years, and after 5 years I'm gonna return you $100. So that's how we differentiate cost of equity and cost of debt. So these are the most common two ways to raise fund, which is debt financing and equity financing. But there is another way which is also there in the market, but it is not very much common. The third one is preferred shares. Now what are preferred shares? Preferred shares are nothing but it is a special case of ownership, or you can say equity financing. Now why this is a special case? Because it combines characteristics of both equity and debt. And how is it has a characteristic of equity and debt? Because when you own preferred share, you are given part of the company, as well as you have been promised to give a fixed dividend. Now there are different types of preferred share also. In some preferred share, you must receive the dividend irrespective of whether the company is profitable or not. That happens in the future when the company turns profitable. That's a separate thing. We will discuss this thing in next videos. So now we know that there is third way of also getting fund in the market, and the third one is preferred share. Now since it has some special clause and it act as both equity and debt, it falls in between debt and equity, and we have here preferred shares. So cost of debt is always the lowest and cost of equity will be highest, and preferred share is gonna fall in between. Now comes one important part, is that cost of debt is tax deductible. And why is it so? So the basic principle behind is that when you borrow funds, you have to pay interest on those. Now these interests are treated as business expenses, just like other expenses like salaries, rent, or general administration expenses. These are treated as business expense. Now if something is considered as a business expense, the law allow, or the under authority allow you to take it as a tax shield, and you can deduct those amount from your EBIT minus interest, and then you get to the number which is profit before tax, and then you pay tax on these number, which is PBT, usually known as profit before tax. So cost of debt is always a tax deductible number. Now let's understand this WACC formula. Now as name suggests, WACC is the weighted average. Now weighted average simply means that whatever the weight of debt we have in capital structure, that will be multiplied with our cost of debt, and then we're gonna add weight of equity times cost of equity. I am taking example of debt and equity only here because it is the most common way to get to the WACC, because most of the company has only these two things in their capital structure. Few companies also have preferred shares. So if you see some company having preferred shares in their balance sheet or their financial statement, you can simply add them, and because it's a weighted average, so it does not gonna change the formula. So let's look at example. Suppose there is a company A which has $100 of debt and it is borrowed at rate of 6% per annum, and it has 100, let's say for sake of it, $100 of equity also, which has a required rate of return. I'm not gonna say it has been borrowed at certain percentage, because it's not actually borrowed. It is that when we invest in equity, we expect certain return from it. So let's say we are expecting a 10% return from equity. Now using the formula of WACC, and we also have to take consideration of tax rate of that company. Let's say tax rate is 30%. So when we calculate WACC, it will be 100 upon 200. 200 here is our total capital structure into our cost of debt, which is 6%. Now because we are taking tax advantage of the debt fund, we're gonna subtract that from our cost of debt, which will be 1 minus 0.3 plus 100 upon 200 into 10%. Now if we calculate this, it will come out to be, let's say, 1 by 2 into 6% into 0.7 plus this is 5%. Now this is 3% into 0.7, which is nothing but 2.1%, plus 5% equals to 7.1%. So here our WACC is nothing but 7.1%. So if what does this 7.1 means? It means that if you are taking a project, let's say you want to take a project B, and the B project in the future will gonna give you return of 9%. So this 9% is greater than 7.1%, which means this project gonna give you more to the, it gonna add more value to your company. But let's say there is another project C which only contribute to 5%, which is less than 7.1%, which means if you take out this project C, it will do nothing but reduce the value of the company. So WACC is taken in the context of whole firm or company, and it is the minimum rate of return required to run the company or to keep it profitable. Now that we know what is weighted average cost of capital, there comes one more thing which make people confusion, which confuse people actually, and that thing is cost of equity. In some valuation scenarios, there is given a cost of equity and there is also given WACC. So people usually get confused between which one is the right valuation matrix for them. So let's think it simply that when you want to value the firm as a whole, which is nothing but debt plus equity, you're gonna use weighted average cost of capital. And when you're gonna value just the equity part of the business, not the debt part of the business, and calculating the equity part of business mean that you are not taking care of the debt part, or you are subtracting the debt part from your valuation, then you're going to use the cost of equity. In the next video we're going to understand in deep about how to calculate cost of debt and cost of equity, and then we're going to link these two numbers to weighted average cost of capital more diligently and carefully. I hope you enjoyed this video, and if you like this video, do share with your friend and subscribe to this channel.